Hello, everybody. I'll kick off now. Can you all hear me okay? Can you see me okay? Yeah, that's excellent. Okay, well, thanks for taking the time to meet with me in this in your busy lives for this webinar. It's a great pleasure to get to know you all. Am I allowed to share screen, Tracy?
Yes, you may.
Yeah. Okay. So in this course, this is I think we started running this course in 2017. Since its launch in that year, the course has had 18,000 participants until now. And in this run, I was going to show you how many students and where you all are, but I can't seem to share my screen. Can you allow me to do that, Tracy?
Yes, give me a second.
Yeah. Okay, while Tracy is trying to sort that out, I was just going to show you the sprawl of the participants in the course, because it has I think this time round we've got 3,000 students participating in the course, which is yeah, quite good. And from India there are 77 participants alone. In the US there are 68. I saw quite some active participation from Brazil. There were 13 students from Brazil. So it's got a lot of international sprawl. And as I can see in the forum, you've got some wonderfully diverse backgrounds. There are people who are very experienced in the field of project finance and have been doing many deals, some even towards the end of their careers. There are some people who are younger. There are people who are coming at this from a technical background, people who are coming from this from a financial or a legal background. So it's a wonderful mix. And I think that gives you a good opportunity in the forums to share your experiences. And I see some quite good sharing of people posting questions in the forums and getting answers from other participants in the course that are experienced in other fields. So I think that's it's a wonderful mix of people. I always find it very inspiring to be able to work with you once a year when we have this course. So what we do, all the course content is now live. So you've been able to see everything there is in the course, including a wrap up. You still have quite a few weeks to finish all the materials, and I think the cutoff, if I understand correctly, is the 8th of April. So by the 8th of April, you need to have finished all the content to be able to get the certificate if you're participating for the certificate. So that gives you, I think we try to plan with a lot of extra time so that you can fit it into your busy professional lives, because this is a course that's aimed at professional, people who have a busy life. I hope everything is going according to plan for all of you. I see we now have we have Pim van Cape, we have Hugo Goosman, we have Bernardus Puladi. Do you want to just give it ever so quickly, maybe starting with Pim, whereabouts are you and what's your background?
Yes, good evening, afternoon, morning, or night, wherever you are in the world. I'm Pim van Cape. As you can see from my name, I'm a Dutch national. I work for a Norwegian company, Aker. In specific in the carbon capture, as you probably have seen on my background. I'm a chemical engineer from the University of Delft, and
okay.
Yes, and my role is a regional sales director in Aker Carbon Capture. But yes, to enable these sales, we need to develop projects together with customer and value chain. Porthos is an example, and
wonderful. Yeah. Thanks for that, Pim. And Hugo, you're in Brazil, I saw.
Hi, hello everybody. Hi. Well, I'm from Brazil, yes, but in fact, I'm in Norway. I live in Oslo for the moment.
Okay.
Yeah,
That's two Norwegians.
Yeah, no, I'm Brazilian, right?
Okay.
And I might be back in Brazil next year. So I am a civil servant of the Ministry of Economy in Brazil, but now I'm under leave, and I have worked many years with concessions and PPPs in Brazil. And currently I work mostly as a consultant on PPPs for the UN and other non-for-profit organizations in countries like in Africa, helping them prepare projects and programs of PPPs, but always from the perspective and point of view of the public sector.
Okay, wonderful. Thanks, Bernardus.
Hi, my name is Nico. You can call me Nico. I'm from Indonesia.
Okay.
I've been working as a contractor for about 10 years. I've been doing projects such as a power plant and refinery in my career. Thank you.
Okay, wonderful. Okay. Puladi? Ali?
Yeah. Hi, everyone. Yes, I'm Ali from SBM Offshore, based in the Netherlands. I'm from technology department and acting as a technology lead. Unfortunately, I didn't have the opportunity to attend actively in the course since I became father, so with 2 little kids, so you can imagine it's thank you. But today I received the notification emails and I noticed it's a wrap-up session, so I thought let's get the opportunity and maybe I can catch up in the coming weeks.
I'm sure you can. As I said, you've got until the 8th of April to finish everything, so that should give you some more time. Thanks for that.
Sure.
PC, Mr. Chela.
Hi everyone, my name is Philip Chele. I'm a transport engineer based in Nairobi, working with the European Investment Bank. I'm coming from a purely technical background. I have worked on transaction advisory for a toll road before, so this is looking to deepen my knowledge of project finance, especially for my current role, and also where the sector in Kenya is headed.
Okay, wonderful. Thank you. Thank you. I think that leaves Louis.
Hello, everyone. Can you hear me now?
Yes. Yeah. Good, loud and clear.
Yes. I'm Louis Murego from Rwanda. I'm a project manager with a civil engineering background. I'm also coming from a very technical background. I work in hydropower projects, construction of hydropower projects, and yeah, I'm looking to expand my knowledge to project finance, also to the other side of management and finance.
Isn't it wonderful?
I've been following the
Sorry.
Yes.
Go ahead.
No, sorry, I was just going to add that I've been following the lessons. I'm on the current one, the last one of the project finance model. It's been very interesting, and I'm looking forward to this session.
Excellent. Oh, I'm glad to hear it. I was going to say, isn't it wonderful, the technology that we can be talking to people in Nairobi, in Norway, all over the place, and how you all have very diverse backgrounds, and I think that's very inspiring. So what I would like to try and do is I've gathered some questions that were given in the forum that we can discuss further. And then towards the end, I think I'd like to reserve an hour and a half for this seminar or for this webinar. Towards the end, I'll be asking if you've had any other questions or any other thoughts or things you want to share before we wrap off. I have maybe this being a webinar and the questions coming in as time went by, I haven't prepared slide materials or PowerPoints or things. I've just typed for myself a question and answer sheet that I would like to share with you by sharing my screen. Unfortunately, it's not going to be very well organized, but you can see my my screen now. Yeah, okay. So I guess one question that was put forward to Hugo, who's on the call now, Hugo from Brazil, but now in Norway. He was saying that he'd worked before on a project in Colombia for the Ruta del Sol. This was a project where the concession term was not a fixed term, but was a term that was essentially left to vary in such a way that the term would always match a certain IRR and always match a certain return for the investor. And he was asking what we think of that. And I think it's a very innovative way of doing it. Let me just to explain it a little bit further for the ones who don't come from this from a technical background or from a financial background. What you may remember in one of the earlier exercises that you can calculate the internal rate of return by taking the cash flows, first the cash outflow, because you need to make an investment, in this case an investment of 1,000 in year 0, and then you can expect to get certain cash flows back. And let's say, for example, that this is a toll road that we're building in Colombia, and we're expecting to get toll revenues after we've constructed the road. We don't know exactly what those toll fees are going to be, because the usage of the road is difficult to predict beforehand, and the risk that you have if you fix a concession term, if things go really well and the road is used a lot, then the return for the investors can be enormous. They can get a very high return, which we've seen in Europe sometimes creates political tension, because then when journalists and newspapers get hold of that information, they say, what was the government thinking that they were offering a private company this much in return? So it becomes a bit of an embarrassment for the government. Or conversely, the usage of the road is not according to what it was expected, but is actually lower than expected, in which case the return would go, could be much lower, which means that the company is not going to be able to recover its investment and may run into financial difficulty. So just here we have, say, the case that we had been expecting. So we had a 250 coming in, and this was indexed through to inflation, for example. And based on these assumptions at the time that we signed the contracts, we were expecting the company to generate a return of 11.4, which we were thinking, oh, that's a good enough return that we can explain to the other stakeholders. So this is what we signed the contract on. But then, as it turns out, let's say that instead of the road yielding 250, it actually, it actually yielded 300, which meant that the return that the investor makes on this project, or the sponsor makes on this project, wasn't the 11% that we were expecting, but was 18, or let's say even more extreme. He made a return of 25, 26%. And we want to avoid that situation. What we can do then is we can shorten, in this case, we could, for example, we could shorten the concession period. That's too much. So if we wanted to end up with the 11% that we were originally envisaging, we could give them a concession period of, in this case, 4.5 or a bit under 3.5 years. So essentially, we're adjusting the term of the concession to reflect the actual cash flows that the project is yielding after it was opened. And by doing that, we're essentially ensuring that the IRR that we expected is always the level that we were expecting. We think this is a good model in a situation where the revenues can be expected to vary from time to time, and you don't know beforehand what they're going to be, as in the example of a toll road model. And this model has been successfully applied in the Netherlands as well for certain investments. Hugo, have you got any other thoughts on this? Because Hugo, this was your question. And did I answer your question?
Yeah, in fact, I shared this example because of a comment of another participant. I don't remember the name. And afterwards, I revisited this is a study case that was published by IFC, I think, and I didn't participate directly on it. But and then I revisited because this participant made some comments about the IRR, if it would be or not the best, let's say, indicator to use in this case. And then revisiting the study case, I saw that in fact it says that it's a certain net present value that is agreed when they sign the contract. But in any case, you know, the point of this example, as you have highlighted, is from the perspective of the public sector, is always like, if there is like too much like gain from the private sector, that's not the best option for the public sector and for the society as a whole. So how can we have like intelligent mechanisms in the contract that allow us to like tune that? Because if we were on the other extremity, when there is a less demand, in general, the government offers guarantees. So when you, like the private sector is making a lot of money, why not share the profit? Not necessarily reducing the amount of years in the concession, or maybe sharing a percentage of that gain. And then maybe I can just add another question to this one in your comments to see what you think. Do you think that embedding this kind of profit sharing in contracts like that increase the risk aversion from the private investors or sponsors, or maybe the lenders, more the lenders? I mean, this is something that helps or may make the life of the public sector a bit more difficult when they try to do that, and for some reason the entrepreneurs are not that interested anymore. From your experience,
I think we've looked at an example where there's a profit sharing because the project is more attractive than what was originally intended. You can also see the converse, of course, that in a situation where the actual usage of a road is not as high as expected, meaning that the returns are actually suboptimal, and then you could obviously you could share the loss of that by giving a longer concession period, for example. I think a clause like this to a project and to the financiers of a project should be a positive clause, because it's essentially taking the risk of a higher and a lower return away from the project company and its financiers, and it is putting that risk on the government for the by the adjustment of the mechanism. So I think it is a positive factor in the project and the project financing, except of course that it may be more difficult to explain because you don't know exactly when. For example, if you have loans with a certain repayment profile, I don't think you can get a bank to make an adjusting loan that extends or that reduces as things are going by. So it's not a perfect solution, but I think it will be a helpful factor in de-risking the project and the financing.
Thank you.
Okay. If there are no other questions
Can I ask a question on that?
Sure. Yeah, sure.
So in that model, you've assumed that the investment in the asset is then spent, but the residual value of the asset, so that's going to go on the books and depreciate over time. By cutting the term short, you bring the transition of that asset to, I would imagine here, the government forward, which then complicates the whole picture, because that then brings the value in time forward and impacts the IRR again. Or am I now completely lost in the model?
What you're saying is correct, but what I am assuming, which I didn't say, is I'm assuming that at the end of the concession period, the asset is transferred to the government for zero value, what we call a BOT, a build, operate and transfer. So the operation period is a period that you are able to earn these toll fees, these toll revenues, these revenues. But at the end of the concession period, you give away the asset, in this case, the toll road, to the government for nothing. So I'm assuming here that there is no residual value at the end of the line for the project company, because it's essentially transferring the asset for zero.
But then you still would have to take that into your accounting then, that you suddenly write off that asset over a shorter period of time. If you are, after 2 years, very successful project, your concession revenue is much higher, then suddenly you get the message, well, congratulations, the IRR has exceeded a certain threshold, term is going to be shortened. Well, that's probably more an accountancy course.
Exactly. I think it's important to keep in mind that when we do these calculations of IRR, we look at the cash flows. We look at the actual money coming in or going out, and the actual money coming in. When you talk about depreciation, that's actually an audit or an accounting fiction, where you essentially write off an asset that has a certain useful life over its useful life. The idea being that you save up money to buy a new asset. If you have a car and you are expected to drive the car for 5 years, then you essentially you run into your accounts a negative a depreciation of 1/5 of the value of the car every year. But for that's not a cash flow; it's a book entry.
Yeah.
So it won't. Yeah.
Thanks.
If I just can add something that might be interesting. For example, in Brazil, we have used to improve the net present value of these projects. We have used, for accounting purposes, accelerated depreciation. So we would accelerate the depreciation of the asset, because it will make some taxes lower for the private party, and then for them, from the point of view of the project, is better, because then they have a better net present value.
Exactly. Yeah. Then you're essentially once again you don't take into account in your cash flow analysis these depreciations, but you do take them into account in your tax accounting. And if the depreciation reduces your profit, it reduces your tax, and that's a positive cash flow or a less negative cash flow. So that's a good way of doing it. We do the same in the Netherlands. The only thing that makes that complicated is essentially you're giving a kind of a subsidy in the form of a tax break, which only has a value if you're in a tax-paying position. We have this with renewable energy projects, for example. You can get an accelerated depreciation. It's not a very efficient way of subsidizing a project, because very often the most difficult years are the early years when you're still building or you're still starting up the operations. And in those years, you don't have any tax income, and therefore you don't have any tax pay. So it doesn't really make any difference. Emmy, kun jij hem naar buiten laten? Okay, shall we move to, this was another question from Hugo. You were very active. We saw that you in order to do the discounted cash flow analysis, to take into account the fact that cash flows come in earlier or later, you apply a discount rate. You calculate the fact that cash flows come in later by dividing them by the discount rate to the power of the number of periods that you need to wait. And obviously, if you're in a very high interest environment like South America often is, the impact of having to wait can be enormous because the inflation rates can be high and the interest rates can be very high. Hugo was asking what discount rate would we apply, and can we apply the WACC, the weighted average cost of capital? I think in answer to that, yes, that would be a very good way to determine the discount rate, because what essentially the weighted average cost of capital does is it takes the level of funding cost. If everybody who gives you money, whether it is senior loans, junior loans, equity, or whatever kind of investment they do in you, if everybody makes the exact amount of return that they are expecting, then that would mean that the project is essentially adding as much value as it is costing. So it is in an economic sense, it is exactly break even. So using the WACC as the discount rate, I think is exactly, it does make sense, and it's exactly the right way to go about it. And then you said, what if in a worst case scenario, so in a cautious assessment of what the project is going to yield, it gives an NPV of slightly above zero, assuming the WACC. Would that be enough to make the investment decision? I think the answer is yes. If in a worst case, you still make the amount of return that everybody needs, that if that's your worst case, then it probably means, and hopefully means, that your base case is going to be more favorable, and that the project is going to add even more value than what you need for the weighted average cost of capital to be earned back. Does that make sense, Hugo?
Yes. In fact, when I started the course, I hadn't verified my account, and then I didn't have access to the the copies of the book. And then during your videos, you don't mention the WACC, but then after this is mentioned in the books and also in the spreadsheet, you use the WACC as the discount rate. So that was, but it was, I mean, this question was more motivated because in one of the videos, I think, or exercises, I don't remember, there was a discussion about if the let's say the NPV is a little bit above zero, or maybe the internal rate of return is more or less what is expected, maybe the investors would say no to that investment. So I was more wondering in my mind how far we should expect to change these references to be able to make the investment decision.
Yeah, no, I think that the difference between the case you describe and the example I gave in the video is, if in the base case, essentially, I guess you can distinguish in the project the base case, meaning what you actually expect the project to yield if everything goes according to plan. And you have a worst case, which is essentially assuming the worst, assuming that things are worse than you expect. If a project in the worst case makes a return equal to the weighted average cost of capital, that's not a bad place to be in, because then under normal circumstances, if things go according to plan, then the base case would be above that. So I think the example you were alluding to in the course is where I was saying the base case is only the WACC. Your question related to the worst case being only the WACC, and that makes a difference in my view. If the base case is only the WACC, then you still have the risk that things are not going according to plan, and therefore you have a realistic risk that the investors are not going to get all the returns that they were expecting. And that I think brings some tension. At what level it would need to be above, that was another question you were just asking. It depends on the level of risk. If the level of risk is higher, then you'd need a higher hurdle to cross. If the level of risk is relatively low, then the hurdle could be lower. So if you have a project that is purely concession based and you have no market risk, and the government has essentially guaranteed that they will pay you a concession payment, a fixed amount, I guess you wouldn't need a very high hurdle. But if you have the commercial risk of a toll road usage, for example, then you would need to apply a higher hurdle. But it's difficult to give you an exact level of that hurdle because it depends on the risk and the project nature.
Just as an example, a rule of thumb in the Netherlands, maybe, for one sector specifically?
Well, in the Netherlands, if you have we are a AAA rated country, which means that our country has the highest level of rating, just as Norway would have, for example. If the Norwegian or the Dutch government would give you a guaranteed concession payment, then essentially you have zero, you have virtually zero or very, very small commercial risk. In that case, if the project made the WACC in the base case, I think you would do that, because then essentially everybody is being paid exactly what they are expecting to give you the money, and the chance of something happening that's not going to lead to that end result is very slim. So in a Netherlands toll road concession structure, I think if you could stand to make the WACC, that's probably quite good, and that would probably mean that you do get a go ahead on a project like that.
Okay, thank you.
Any other questions on this point before we move on to the next question? Okay. I guess quite a few of you are in developing countries, so I guess this question is relevant in many projects. We have a situation where you have a host community. You're building, I don't know, you're building a factory in a certain location, or you're building a road in a certain location. And after the project has been constructed, after the project has been starting its operations, there is interference from local host communities, or there is a political interference from local leaders who essentially want to try and blackmail the company or the project to give them either bribes or better terms, or they essentially try to renegotiate the terms, and they threaten to stop the project, or they threaten to revoke licenses, or they do certain things to create mischief. And of course the project is vulnerable in the sense that after it's made the investment, after it's created the asset, it's created the project, before it was a prospect and it was very welcome. Now it's spent all the money. Its only source of income now is the continuity and the success of the project. So it can be a victim of this kind of conduct. And of course, if you have a change of government, or you have a change of policy within the government, not all countries and not all locations are as stable. So that does create a risk for the project and for the investors in the project. So the question was, how would you do you recognize this? Are you working on any projects that have these kind of issues?
Yes, I have it.
Yeah.
May I share my experience for this?
Yeah.
I've been working for a refinery project in Balikpapan, Indonesia. It's a mega project in Indonesia. Right now it's already 90%. So at the time, we had a local community that tried to bribe us. I mean, they want some money from because they know this project is quite big and maybe there's some money on there.
Yeah.
But we don't want to give the money free to them. So what we propose is we ask them to work in the project as a worker. So we treat them as stakeholders. So I mean, so that they will get the money, but not in free. Yeah. So I mean, that's one of the solution from us, so that we reduce. I mean the class from big local community and in the near projects. That's my experience.
Yeah. Okay. That's very good. Essentially, what you're trying to do there is you're creating, as you're saying, you're making them a stakeholder. You're trying to make it a win-win situation. If the project wins, they win.
Yes.
Yeah. So I guess one of the starting questions in a project financing, when you identify a certain risk like this, is you start to look at the stakeholder in the project who is best able to manage a risk like this. So if you had a choice between giving the project sponsor or the foreign company that is the owner of the project the responsibility for solving this, do you think that would be efficient?
Yeah. In my experience, we try to prepare some money on that, so that when there is some problems occurs, so that we have some budget for that. So
yeah. But my assumption is still, even though you set aside some money to solve these problems, I think if the foreign company is the one who negotiates a settlement and who tries to resolve this, I don't think that's going to work, because it doesn't understand the local dynamic. It's considered to be an infinitely wealthy company. The price that is going to have to pay if it wants to solve this, I think, is always going to be too high. So I don't think this is a very successful way of solving it, to make the foreign company solve it itself. I think what my experience, I used to live in Jakarta as well, so I know Indonesia a little bit.
Yes.
If you can make the host country hire leaders solve this for you. So in your example, you had the troubles with the local communities in Balikpapan. Would it have helped there if you had Kalimantan leaders or Jakarta leaders to take responsibility for this issue and to solve it for you? Would that have helped?
I don't think so. In my experience, we solve it by ourselves. So I mean, actually, this is a joint operation project. So my company is make a joint operation with some Korean engineering companies. So we the Korean doesn't know the situation. I mean the about the local. So we try to explain to them on how to manage this community, what kind of activity that they will do if we don't provide some money. Maybe they will make some class in our project. So So yeah, we make some what kind of what is that? Is it some of more soft approach to the community?
Yeah.
We do discussion. We try to we invite them to meeting in our site. We treat them with some foods, drinks, so that they can share what is their purpose, and then we try to solve this issue, something like that.
Yeah. I think as I wrote in the forum to this question, careful stakeholder management is key to ensure that the local communities are feel heard and fully informed of the plans and benefits of the project, so they understand that the project benefits the local communities as well. And it's important to ensure that these local communities benefit directly from the success of the project, so that you make it a win-win. And that's essentially, like you were saying, if you make them potential employees of the project, then they can earn money, they can earn salaries from the project success. So I think that that's very useful. And you'll be interested to learn, Bernardus, that we actually have similar situations in the Netherlands. We have a town in the Netherlands called Urk, where there were 2 wind projects being developed on 2 different sides of the same village. And one wind project ran into one legal claim after another, and local interest groups were always fighting the project and were always resisting the creation of the project. On the other side of the village, the local communities actually accepted the project quite early on, and that project was actually finished almost 2 years earlier than the other one. So one was clearly a stakeholder success with local communities, and the other one was not. And the main difference between these 2 projects is that the project that was a success essentially gave a percentage of the project to the local community, and essentially said, the profits that we make, we're going to use to support the communities by building housing, or by building schools and infrastructure. So essentially they made a direct benefit for the local communities of the project succeeding, and that made a big difference in how the project was approached by these local communities. In some countries that I have a very top-down approach, so that you have powerful leaders higher up. Sometimes you can solve these issues with a government support agreement, that essentially you have the highest local government authority taking upon itself to deal with these kind of local stakeholder issues, with the threat that if there is a donor organizations like the World Bank involved, or the Asia Development Bank, or that can put pressure on the local political environment to avoid embarrassment with these kind of organizations as well.
Yeah, unfortunately, in my case, there is no help from the top. So we do it by ourselves. So that's one of the lesson learned that I can. Yeah.
Okay, well, I guess the conclusion is there's not one answer. It depends very much on the situation and the country. What is the best strategy? You can also see the opposite. We've talked about how the government and local interest groups blackmails the project. You can also see a situation where the project blackmails the government. You've got the concession to run vital infrastructure, which is clearly very important for the local host country. And then the project sponsor or the project essentially abuses its power and tries to demand more favorable terms, and puts political pressure, threatening to stop delivery of power, for example, or to stop the road from opening. Have you ever come across that? Have you ever seen that? Okay, this was a question in the previous run of the course. I must say I have not seen this a lot, because I don't personally think that as a visiting project in a country, you have the power to blackmail the local environment. What you sometimes see, for example, is that the project is a project that invests in US dollars, in an international currency, because it needs to recover its investment cost. It tries to get the same currency revenues. So if it invests in dollars, it wants to sell its power or its toll fees in dollars. And if the currency is a currency that depreciates against the dollar, you can sometimes see that the project revenues become very expensive for the local people, if they have to pay in dollars, and the local currency, say the Indonesia rupiah, depreciates, then at some point the power just becomes impossible to buy, given the income levels of the people. But the best way, can you think of a way to avoid that these kind of currency movements affect your project and create a problem? I think one way to do that would be to, and I think this is also an example that we saw in the course material, that you can try and hedge the risks. So if there is a risk of the local currency, if you have a revenue in local currency, say in rupiah, and you have an investment which is in international currency, say the US dollar, that you essentially hedge by buying forward US dollars and selling rupiah forward. In that way, you hedge that risk. Essentially, you buy insurance against that kind of currency risk. Any further thoughts?
We had a hand. Yeah,
Yeah.
we had a hand earlier.
Okay, thank you for
I
that.
did have a question.
One or two, yeah.
So what if, going back to question 2, if the government is looking to change terms, say a project was approaching financial close, then a new government came into place, and suddenly the fiscal environment is different. So there's not enough space to accommodate availability payments. So they go back and they ask the project, the SPV and the project company to restructure the project, either through descoping or basically rejig the proposal into something more palatable, keeping in mind that the government that's come in, it's a key road to their stronghold or their base, and their political base doesn't want to pay toll. So how do you deal with that kind of scenario?
And when you say it doesn't want to pay toll, essentially, I guess in my mind, it makes a difference whether the facts or the situation has changed in such a way that what was originally envisaged no longer makes sense, and therefore that there is a basis for re-examining what the assumptions were and what the situation was, and essentially you can come up to an open and constructive renegotiation, or a situation where essentially a government is just trying to abuse its power. Essentially, it doesn't want to pay. It had agreed before that it wanted to pay, but now it's changed its mind, or there's a new leader who wants to show he's powerful, and he essentially refuses to accept the original terms as they were originally envisaged. To me, those are two different situations. Which one do you mean?
I think I mean on the surface they say it's about the cost, but I think in my opinion at least, it's more of they don't want to accept the terms.
Yeah. I think the best. So this is essentially a political risk that the project runs, of the government abusing its power, changing its mind, and blackmailing the company. The best protection I can think of that, because clearly, as a company that has already built a project in that country, you're quite vulnerable. if the government stops you, if they send in the police or the army or they local riots, then that's clearly going to be a very damaging situation. What I said in the course is that one way to mitigate this is to make a government, an international stakeholder in the project. For example, if the IFC or the World Bank is a co-financier, or if a donor country is a co-financier, or you have a political risk insurance from the local, from a government insurance company. In that situation, I guess you have more of a political balance, because then you have a political interest in let's say Nigeria, for example, but you also have a political interest from the World Bank or from the African Development Bank, or from to stop the government abusing its power. And you can then also determine that if there is a dispute, it's not brought to a local court in Nigeria, but it's brought to international arbitration, so that at least you have a judge looking at it with international experience. It's still not perfect, because if the local government still refuses to play ball, then I guess you're still going to be vulnerable. But at least you've got a powerful friend or a powerful ally if you have the World Bank or the African or Asian Development Bank on your side. Does that make sense?
Yep, yeah, it does. It does.
Yeah. Okay. Moving to the next. I'm very sorry. I pushed the wrong button. My apologies. Okay. Going back to the next question. You can all still hear me?
Yes.
Yes,
Yeah.
yes, you can hear.
Perfect. Yeah. Okay. Thank you. This was a question from Yassine, who by the looks of the nature of the question is in the UK. She said the lecture this week highlights how the PPP, the public-private partnership model, has been successful and is a good model to finance public infrastructure projects through its effective sharing of risk. However, in the UK, at the very least, I had the feeling that PPP is now generally seen as a failed model because of some high-profile failures. So many end up in legal battles and are wound down, and the value for money for the public remains dubious. As far as I know, the PPP model has been largely abandoned for new projects. And she's asking, what's our a view on this? Do you guys have a view on this? Do you see many projects, PPP projects, that end up in legal wrangling and end up being a failure?
I added a comment to her question.
Yeah, I saw
in
this.
regard. Yeah. Well, I think in the UK, maybe the main reason that they phased out is because they were really like with a large commitment in terms of availability payments for a long time, and then they decided to rethink that. I had a picture of that, but I think in 2015-16 it was like 10 billion pounds per year, and then they would need at least 15 years more to phase out that. So I don't know. From I think the UK government is so sophisticated in terms of how they procure projects and the expertise that they have built this 5 case model that has more than, I don't know, decades of test proving. So I think they can still do other kinds of procurement, still very effectively, keeping the value for money. But I think that maybe in the past, I was just revisiting one related to the previous question. In 2004, the World Bank published a study, granting and renegotiating infrastructure concessions, doing it right. This is 20 years ago.
Yeah.
The records were not so good by that time, but I think we have evolved a lot, and all this problem of fiscal risks related to PPPs, they have risen. And then after the pandemic, they became more clear, the iceberg that we have. So I think that with the tools that we have today, if we do it right, and I think that we can pretty much have a very high successful rate of PPPs. I can give you a very recent example. In Brazil, for the there is different jurisdictions there in terms of what sector is in which level, if it's federal, subnational, or municipalities. For example, for solid waste and public street lighting, it is in the municipality and state level. And many of the municipalities, we know, they do not have the capacity to prepare this project if they are not that big. So a few years ago, we established a fund to put money to prepare these projects using one of our public banks, and it was a revolving mechanism. So we would prepare the projects, and then after the tender, we would make the private sector repay a certain amount to reimburse the fund.
The money. Yeah.
Exactly. So in the first 18 months, 3 years maybe, they started developing the business model, the contracts, let's say the architecture of the PPP contracts. But after this learning curve, 2-3 years, they started doing, and there was a lot of demand. And I don't know the very recent numbers, but the last time I checked, there was a record of more than 50 projects delivered, and the rate of success was above 95%. So I think that if we do it right, we have the methodology, we know what needs to be done, we can be pretty much in the success side, I would say.
Yeah, that would be my view as well. And I think you also added in your response, project finance, it's not a miracle solution. It cannot make a bad project good. If a project is badly designed, if a project has really fundamental problems, the fact that you have a project financing setup is not going to provide you with a miracle solution. So we see in the European environment where projects run into difficulties, it's mostly because the projects are too large or too ambitious, and that the risks, essentially the contracting network pushes the risks to the private companies. So essentially they have to undertake that all the risks that will materialize, the technical challenges and problems, will essentially be challenges and problems of the private sector players, and they just don't have the balance sheet, or they just don't have the resources to solve. So then it really becomes an issue of does the company go bankrupt, or do we renegotiate? And because we've had some really large and really ambitious projects that have run into these kind of difficulties, it means that the list of people, of organizations that are willing to participate in a PPP, or that are willing to render their services or invest in a PPP, is reducing because the risks are so high. To me, that's still better, and I recognize your finding, Hugo, that if I compare that to the situation before we had project financing, it was a much more unclear and unequal situation, where you had a government that essentially contracted with an organization to build something. The government never had the amount of experience or knowledge that it needed to be able to identify all the risks and all the problems that could materialize. And then after the contract was signed, essentially the government was very vulnerable because the local contractor, whenever a problem could occur, they would essentially say, well, we can stop building now and we need to renegotiate and we need a bigger fee, or we need the investment is going to go up. So almost invariably in these projects, they went over budget by horrendous amounts, often more than twice, 3 times as much as the original intention, and they overran, and they still had legal wrangling. So I still think that preparing a project financing beforehand, identifying all the risks and all the potential problems and pitfalls early on, and bringing a clear responsibility and a clear balance is the right way to go. And particularly if you are talking about an environment like in Brazil or Nigeria or Indonesia, I think the fact that there is international legal experience, international technical experience, you're essentially creating a first world environment that is going to help the success of the project, from the fact that there's a lot of experience and a lot of knowledge that's went into these kind of structures that you can benefit from immediately. So the fact that you have a 95% success rate, that's enormous. That's a very healthy, that's a very good success rate. So I don't think it's a failed model at all. I think it's not a miracle solution, and you need to think about very carefully which projects you put up for investment anyway, whether through project financing or through other means. Any other thoughts on this?
Yeah, if I could just comment on that, Emil.
Yeah, sure, Louis.
Because when I first saw the question, I was in agreement, because in the opinion I had was that PFI and PPPs seem to fail tremendously. But I really like the answer, and I like how you explain it, because it makes sense. I think the challenge was more taking it like a magic solution, putting overly ambitious projects and thinking this will now, this is what will make it work, without considering all the risks. I think that not just in the UK, I think even in Australia, they faced some very big failures with their toll roads. But the issue is along those lines of just putting overly ambitious projects, thinking the private sector will tackle that challenge without really considering, doing proper risk management. And the one thing I had in my mind was that even though these big projects, the private sector is supposed to bring a competitive edge. It's supposed to bring private companies to compete to get the market. Usually the projects are so big that very few companies are up to the task in a country. Like, if these big projects go up, it will usually be a joint venture of 2 or 3 of the big companies in the country that are participating. So then you have pretty much only 1 or 2 participants, and they're almost guaranteed to win it. So they don't have to be that competitive, because options are limited.
Yeah.
But then again, I think I really liked this the discussion on this.
Me too. And
to another view.
And I guess another thing to emphasize is that in project finance, you try to find a legal solution. Essentially, you try to agree in a contract beforehand who bears a certain risk or who has a certain responsibility. But that, again, is not a miracle solution, that if it turns out that the original plan is not possible, and that you need to have additional investments, and that those investments are going to be ginormous and very material, then sticking to a contract and essentially saying the contract says X is not going to be the answer. You'll need to renegotiate based on the new findings, and you'll need to come up with a win-win solution, or at least a smaller loss solution for all the participants. Yeah. Okay. Thank you.
It's fully agreed.
Yeah, thank you for that. Yeah, this is not. Yeah, no, I guess I'll skip this one. Have you? Do you have any questions that you would like me to address?
I posted one in the chat, just some comments maybe from your experience. So I phrased like the financial model of an infrastructure project can be used by the public sector as a reference, a shadow bid, to set up tender parameters, minimum investment, tariff cap, etc. Is there any particular consideration or recommendation from your experience on how to use or tune the financial model when we are using it for this purpose? What is the difference between like the government looking at the financial model of a project that it is about to be tendered and the private sector making this financial model to bid in that tender? So what is maybe the key differences there?
Well, I guess the key difference is that both stakeholders have a different interest. The government has the interest to make the price as low as possible and the terms as friendly as possible for the concession giver, and the company has an interest to in the reverse. So if whoever makes the model will design the model to suit its purposes. So if the model is prepared as a preparation for a bid, then the government will have it designed so to meet its purposes. If the model is designed to by the bidders. Nevertheless, I think having a common understanding of the model and having the model be used by all stakeholders has a big benefit in the transparency of ahead of doing the deal, but also in the actual execution of the deal, what the changes are that are materializing, what the impact of them are. So I think having a joint understanding of the model is definitely something that I think is going to be very powerful. If you wanted to do it that way, you would probably want the model to be certified or verified by a big accounting firm, so that you make sure that everything that's in the model is not too one-sided in its design.
That's an interesting point. Thank you.
Do you see that? Do you see in bid preparation, for example, that governments sometimes have the models already prepared by big accounting firms, for example?
Not really. Not that I.
Okay.
I don't know any particular example, but it's a very good idea.
Yeah. Okay.
There is the model prepared by the transaction advisor, but I don't know. I mean, I guess it's used by the government as a reference point, but may not necessarily have the level of detail.
Yeah. But if you could make an integration of that model with the model of the contractors, I guess as long as you make sure that the assumptions that each one makes in its model, because models are like, do you call it garbage in, garbage out? If you assume garbage assumptions, you're going to get garbage outputs. You want to make sure that you're on the same page in terms of what you are assuming, and sharing those inputs between both models, I think, is going to be very, very useful, very powerful.
Yeah, one thing that I can comment is that, I mean, when we make a mistake in the model from the public sector perspective, but then we have a very competitive tender, then the competition may solve the problem. I mean, because you move towards the best solution. But when you have a bad model and then you don't have enough competition in the tender, then you might go into a bad deal, because you cannot like know exactly the consequences. So I think, but also I think that over the years, and when we do start doing projects in a row, we start learning more, and then we tune models, and then we understand better how things work, you know.
Yeah.
And in our case, we have also, for example, a development bank, BNDES, which is very, very knowledgeable in project finance. And then, I mean, with all the experience that we have accumulated in the last 30 years, it makes our life easier. But in the countries that I've been working in other contexts, I see that it's a bit of a struggle when you are starting a pipeline of projects and then you don't have the expertise neither in the Ministry of Finance nor in the ministry, the line ministry that is responsible for that. And then it's a challenge, and you should, as you said, definitely involve the international organizations, multilateral banks, so that they bring this expertise and try to help the government structure the deals.
Yeah. What we also do in our projects, the organization I work for, we also ask for updates of the financial model from time to time, say once a year, so that you can see if there are changes in the market or changes in assumptions. If you can get an update of the same model, you can calculate the impact of that change. So everybody is clear on what has changed and what the repercussions of that are. That also helps. Do you find that you often you revisit the model as time goes by, say once a year, to just see if everything is still going according to plan or what the changes are? Maybe not. Maybe not. Okay, I suggest that we leave it at this. It's very late for some people in Indonesia. It's late for me, and well, it's late for most of you. I'm very grateful for your participation. I think it's been a very useful, very inspiring discussion. I hope you enjoy the course. There'll be an opportunity to evaluate the course after it's ended. So please feel free to give whatever recommendations you have for adjusting the course in a next run. But if you like it, let us know, of course. And I should have asked at the beginning, Tracy has been recording this session. The idea is that we put the recording online so that other participants who couldn't join us for the webinar now can look back. I hope you don't mind that you're in a recording. I should have asked. Is there anyone who does resist that? Okay, good. So we can move ahead. Yeah. So you will shine internationally. Everyone can see you shining in your wonderful questions and inspiring discussions. Okay, if there are no other questions, no other thoughts, I think we should call it a day and each of us go back to our families and friends. Thank you, everybody.
Thank you very much, Emil. It was a very productive
discussion.
discussion. Thank you very much.
Thank you very much.
Very good. Yeah.
Okay.